So today we're going to take a look at how to actually set up and fill out the order form for selling an out-of-the-money covered call on a particular stock that you already own 100 shares of. Hello my friends, this is Legend. So today we're going to take a look at how to actually set up a covered call order form on a stock that you already own 100 shares of. And this will be for out-of-the-money covered calls, where you're looking to actually earn some premium along with some price appreciation. So if you enjoy this type of content, please make sure to hit that like button, as it does help the channel out. So when we're looking to sell an out-of-the-money covered call, what I'm looking for on a chart is, first of all, I would like for that candle to be toward the top of that Bollinger Band. And as you can see, we did actually break out the top of the Bollinger Band on this particular stock, RDW. Now, I actually own some shares along with a couple covered call options already. Now, come tomorrow, if this stock can stay green and stay above that top of the Bollinger Band, I will be looking to actually sell a call on some of these shares that I do have. Now, to sell a call, you have to have at least 100 shares, as one contract is worth 100 shares. So you have to own 100 shares to sell one call option contract. And since RDW is above the top of the Bollinger Band, I would be looking to sell that call so that I not only earn price appreciation, because as you can see, my average is about 10.89, but I'll also earn some premium by doing so. So let's just go through and let's see how to actually create and write a covered call option. So first of all, the first thing we do is, of course, go to the option chain. And that option chain on Webull, there is some tabs right along the top up here. And that second tab that I have, it says options. So that takes us to that option chain. And you can see that this price right here on this black line, that is the actual price of the stock. Now, this is after hours. So any options will not go through because it is after hours. But I just wanted to show how to actually fill out that form and to try to help you understand what you're looking at on the option chain. As you can see, this price right here, $14.20, that is the actual closing price of today, $14.20. So if we're going to sell an out-of-the-money covered call, then of course we want to sell at a price above the current price of the stock. And that would mean it's out of the money. If we're going to sell into the money, then we would sell at a price that is less than the actual stock price. And that would be in the money call. But for this video, we are going to look at out of the money covered calls. First of all, we need to select our expiration date. And if you go all the way up to the top up here, you can see it's just defaults to that first one. So if we click this right here, we can minimize that. And now you see all of the expiration dates that are available currently for RDW. So let's just take a look at February the 6th, as that's about maybe a week and a half out. And we could look at February the 13th, but we'll start with February the 6th. So we'll click February the 6th, and that opens the option chain for February 6th. And you can see, there we go. There's all of those strike prices, as this is the strike price column. There is the actual price of the stock, and that just happens to be the closing price, right? Because this is after hours. And we're going to do out of the money, so therefore we're going to look for a strike above that price. Now in my case, I'm going to say that I own those shares at around $10, okay? I know it's $10.89, but just to keep things a little bit simple, let's just assume that I own those shares at $10 per share. So therefore, anything I sell above $10, it would be a gain as I only paid $10. And even if I sold them for $11, that would be $1 per share plus the premium. So I hope that makes sense. But we're going to do out of the money covered calls. So we are going to look at something above $14.20. And since the current price is above my purchase price, then I'm not worried about letting those shares go. So I would make that price appreciation and I'm going to earn that premium. So let's just kind of look to see what's available. Well, if we look at about the 15 or the 16, it's only going to pay about $1, and the 16 maybe pay 75 cents. And that's not too bad, but let's take a look at the next expiration date just to see if there's much difference. And this is February the 13th. We'll scroll right on down to that 15, that's $1.32, and 16 is about 88 cents. Now, as you can see, the bid ask right here, that's the spread. And this right here where I was calling out 88 cents, that's actually the mid, okay? So that's the midpoint of the bid and ask. The bid would be what you would be selling at, and the ask is what you would buy at. And that difference there, that's the spread. And of course, you have the midpoint, which is somewhere in the middle between the two. And anytime I'm selling an option, I always try to go for that midpoint. I do not want to necessarily pick a 55-cent premium to start with. I always like to try to get that mid. So in this case, if we keep with the February 13th and we want about $1 in premium for this option, then we could select either a 15, which is $1.32, or we could go with a 15.50, which would be about $1.15. Or we could go with a 16 and try to get about $1 if we're willing to be patient and wait, because that bid ask is 60 cents to $1.15. And being at 88 cents, maybe it'll fluctuate and maybe we'll end up getting filled at $1. But again, this is just an example. So let's just go ahead and let's get that order form going. And since we're selling this call, we want to select the bid. If you select the ask, it's not a big deal. It's easily switched on the order form. But just to keep it clean, we'll click sell, right? As you can see that pop up, it says sell order entry. And that's what we're going to do. We're going to sell that call. So we're going to click this right here because we're going to look for a $16 strike at this February the 13th. So we click it and it pulls up the order form. And you can see RDW, a $16 strike for February the 13th. It is a call and you are selling that call. The quantity is 1. That is not 1 share. That is 1 contract. And each contract is worth 100 shares. So always remember that this is the number of contracts, which is equal to 100 shares per contract. And right now I have a limit order and it defaulted to that 60 cents because that 60 cents was the bid. And of course that time frame is for the day. And you can change this to good to close. And that means that this order will stay open until it fills or until you close it. There's about a 30-day window. And if it does not fill within that 30 days, then it will just cancel. But for right now, I'm just going to have it for the day because this is after hours and it's not going to go through anyway. But as you can see, that limit was 60 cents. Well, we were going to try to see if we can get a little bit more for that. If you look down here at the bottom, you can see there's that bid of 60 cents. There's that ask of $1.15. And that was our bid ask spread. And you can see that the midpoint is 88 cents. And that's what we saw on the previous chart. So the neat thing about these numbers down here is just the fact that they are clickable. And if you do click one and select it, then it can go ahead and automatically change your limit price to that price. So for this example, if I click the ask of $1.15, you'll notice that this 60 cents up here, it will change to $1.15. When I click this, there it goes, $1.15. Well, if we click the midpoint, it says 88 cents. But notice it goes to 90 cents. And that's just simply because some stocks are limited to that 5 cents increment. And this just happens to be one of those. Now, if it was not, then when you click that 88, it would actually read 88. But since it's in 5 cent increments, then it just went ahead and rounded it right to 90 cents. Now, I can hover over it and I can adjust it up and down with the arrow buttons. I can go click down, that's 85 cents, or I can click up, there's 90 and 95. So I can pick whatever I want. So everything is filled out. You always make sure that you checked your entry to make sure you're on the right side of that option. And we are selling that option, and that is a call option. And check your expiration date. Make sure that's correct and your strike. And of course, make sure you're on the right ticker. How many contracts do you have? You do not want this to be something other than what you were expecting it to be. If you have 100 shares, then it would be 1. If you have 200 shares and you want to write a cover call on all 200 shares, then you can go here and you can click that and move it to 2. In my case, I have a total of 3, and I could sell all 3 at this expiration for this strike price and earn 90 cents per share. So that would be $90 times 3, which would be 270 bucks. That goes directly to my account, no matter what this option does. But I'll just keep it at that 1 for the time being. Now, once you have checked and you are good with what you have entered, then it's pretty simple. You just hit place order. And as you can see, since we are after hours, it's letting me know that it cannot place this order because we are outside of the trading hours. So options can only be done during trading hours. So all I can do here is just click the OK. So that's pretty much how to actually open a covered call with a particular stock that you're looking at, how to look at the option chain, what that strike price actually means, the bid-ask spread, and of course that mid price over here, which is a lot of times what I do try to get. Now this does say sell because that order was still open as I did not delete it. And then to get back to that order so that I can delete that, I would just go to my order entry and right back to where we were at. And you've got this little box right here with these 3 dots. I click it and I can just delete the order because I would rather look at this come tomorrow. And if RDW is still up, then I will definitely be looking to sell a call on at least on 100 shares of RDW that I own. Now, why do I select the top of that Bollinger Band? Well, it's simple because there is more of a chance of it coming down than to continue moving up. Now, it can, and it has been, right? It has been moving up. So it's very possible that come the expiration date, this one here could be above my strike and those shares would be taken away. Now, you can manage that by either rolling that option, and when you roll an option, you're rolling it usually further out in date of that expiration date. And of course, if you can move it up in price, that only helps you to earn more price appreciation. Now, I suggest that if this is your first time, do not put real money in on it, okay? I would suggest that you paper trade. And to paper trade, you can do it simply on paper, right? You can write down exactly what that order form said at that strike price of $16, the expiration date, and how much you actually earned in premium. I would write that down on a sheet of paper and then just track it so you pick that midpoint as the premium that you did earn, and then follow it through day by day all the way up to expiration date and see if you can follow along on that trade. And if it did move against you, what could you do to combat that? And of course, when I say moving against you, it's a covered call. So if the price does not get up to your strike, then the option expires worthless, meaning that it's worth $0 and it just expires. You do not have to pay anything to close it because it's worth $0. And therefore you lock in that full premium amount as you did not have to pay anything to close it. But find a good stock, wait till it gets to the top of that Bollinger Band and sell a call. Now, of course, when do you buy the shares? Well, I would prefer to buy them when it's at the bottom of the Bollinger Band. So you buy at the bottom of the Bollinger Band and then you wait till it gets on up and then you sell your call. Now, can you sell a call on the way? Sure you can. If you bought them down here at the bottom of this Bollinger Band being about $7 and this thing pops up and say it's at $9 now, could you sell a $10 call? Well, yes, you can. You can sell a call at any point, but I do not suggest selling that call under your purchase price because that would entail a loss in that price. But if it is moving up and you sell that call and it's at 9 and you sell it right here at say 10.50, if it does go above it by expiration and close, then you could get your shares taken away at 10.50, but you bought them at 7. So that's $3.50 times 100 shares. That's $350 in price appreciation, plus the premium you've earned for just selling the call. So you do not have to wait until it gets to the top. But if you already have shares and it's moving up and you just happen to notice that it's at the top of the Bollinger Band, well, then that's a pretty good time to sell that call because it could come back down. You'll just get your premium and get to keep your shares as well. But like I said, it all depends on what your goal is. Are you looking to go in and out of these stocks, basically buy and then sell that call to have those shares taken away, get that price appreciation and that premium, and then do it again? As that could be something that you may want to do. But of course, I am not a financial advisor, and you should do your own research and know how much you were willing to invest and risk. As any time that you're in the stock market, it does involve risk. So I think I'm gonna wrap it up right there. If you don't mind, hit that subscribe button and smash the like button, as it would be much appreciated. And as always, I am not a financial advisor. This is not financial advice. Please do your own due diligence before you get into any stock plays. And until next time, Legend out.